So today we're going to talk about 4 unique ways to invest in property. Now, if you live in Australia, you are pretty much aware of the fact that property is like religion here. You will always hear about boomers who made an absolute killing in the property market by buying and holding or buying and flipping. And to the younger generation, this seems very hard to do, especially with property prices increasing so much over the past couple of years. But these days, you don't actually have to take out a huge mortgage to get exposure to property. Just keep in mind that these methods do have risks, so please do your own research. This is not financial advice. Let's jump into it. Let's start off with number 1, which is REITs, which stands for Real Estate Investment Trust. Now, these are basically companies that invest in real estate. And you can basically buy REITs from the stock exchange, very similar to how you would buy stocks or ETFs. Normally, what you would do is you would log on to your broker, select the REIT, and basically buy it, and now you hold the REIT. And since these assets are investing in property, the dividend yield for these REITs tends to be higher because obviously the tenants are paying rent to the company, and then that rent is passed down to you, of course, after excluding all the costs, by the form of a dividend. Now, a huge benefit of this is the fact that you're getting exposure to property without actually dealing with the headaches that come along with it by managing the actual property, dealing with the finances, paying all the fees and costs associated with the property, dealing with the tenants as well. All of that is handled by the actual company. You just buy the REIT and collect rent and also the price appreciation if the price goes up. So in that sense, it is pretty hassle-free, but I want to make it very clear that these types of assets are not risk-free. Now, as you guys know, property comes in cycles and gets impacted by lots and lots of factors that happen in the economy and globally as well, with the recent huge shift being COVID. Now, when it comes to REITs, these don't just invest in residential property, but they also have commercial property in their books as well. So stuff like warehouses, office spaces, retail spaces, shopping centers, and even like farmland and lots of land as well. So it's very diversified depending on which REIT you invest in. An example I'll give you guys is SCG. Not this one, but this. Scentre Group. If you don't know already, Scentre Group owns the Westfield shopping centres in Australia, and obviously because of COVID, shopping has not been, it's not being done in person for the last couple of years. Only now we're seeing things open up where people are going to shopping centres and really, doing their shopping in person. But through the COVID period, we definitely saw online shopping really go up. We saw a lot of e-commerce stocks as well, basically skyrocket. So in that case, Scentre Group did take a bit of a hit because obviously if the shopping centers are not being utilized, then the value of that real estate goes down. So looking at the share price for SCG, you guys can clearly see that the price was hovering around that $4 mark before COVID. And then during that COVID sell-off that we saw, the share price basically took a massive cliff dive, a massive hit. And then since then, it still has not recovered. Obviously, if you bought during the crash, you would have profited, but it still hasn't recovered back to its original levels at around $4 in the previous year. So you can really see that COVID has had a big impact on real estate. Now, of course, during this period, SCG was paying dividends to customers, but obviously the price gain is not going to be that much. So just keep that in mind when you're investing in REITs. Another factor that affects REITs quite a bit is the fact that this year, in the last couple of months, we've seen that the interest rates are going up when it comes to home loans and business loans as well. And because of course the cash rate has been going up. Last month we saw a massive hike of 0.5% by the RBA, so rates are going up. Now oftentimes there is debt against the property that the REIT owns, so of course as the debt costs more, rates go up. That obviously negatively affects the business. Another example of a popular REIT in Australia is RFF, which is the Rural Funds Group, as you can see. Now after the COVID crash, you can see that it was barely sort of not affected by this at all. During that March period, it still sort of was on that upward trajectory, as you can see, and it still has had a fairly decent gain for the past 5 years at about 50%, and the dividend yield is looking fairly strong as well. Now, of course, dividend yield isn't everything. I made a video about this as well, which talks about the downfalls of just looking at the dividend yield, so make sure that you don't just go off of the yield. I'll leave a link in the description for that video, but you can see that different REITs are priced differently and behave differently. They're not just the same, so just keep that in mind. It depends on really what the REIT is tracking. With RFF, what they basically do is that they own agricultural assets, and then these assets are leased out to farmers. So it is completely different to what we saw with Scentre Group, which is all about shopping centers. So REITs basically allow you to get exposure to property through buying these types of assets. They're certainly not for everyone, and they're not for me, but let me know if you would like to invest in stuff like this or if you're interested. Method number 2 is BrickX. Now, this is a fintech company that allows you to invest in property through fractions or portions of property through their online platform. Now, obviously, as we've seen, the properties in major cities are becoming extremely unaffordable. So this is a solution that basically allows people to get into it and just buy a portion of the property. So how it basically works is that each property is split into 10,000 pieces, or 10,000 bricks, as they like to call it. It's just a fancy word, or not even a fancy word, for portions of a property. So if a property is worth $1 million, divide that by 10,000, and each brick is worth $100 each. If a property is worth 1.5 million, then each brick will be worth $150. So it's basically like fractional shares, if you're familiar with that, but for property. And the whole idea is the fact that you get to invest in investment properties without having to, assess your borrowing power, or getting out a massive mortgage, or dealing with tenants, or, fixing leaks and doing all that sort of stuff. It's a very simple platform, as they like to market it. So as you can see right here, BrickX basically does everything for you. You can see that they, manage the properties on your behalf. They pay all the bills, the tax, insurance, and all that stuff that you have to do if you were the actual owner or the landlord. And they even pay you a dividend or distribution. So you can see you've got the gross rental income minus any of the fees and charges and costs associated with owning the property, the interest and principal payments, and then divided by 10,000 bricks. And that is how much dividends or distributions you will be getting per brick that you own. Now, when it comes to fees and charges for buying a brick, they charge a flat 0.5% fee on each way. So if you're trying to, get into this, you will have to make a profit on the property, and also the yield of 1% to actually make any money on this. So just keep that in mind. It is quite pricey. There is that bit of a transaction cost. So you can basically think of this as a brokerage fee that you would pay if you're buying a stock or a share. But yeah, it does seem quite expensive to get into it. And as an example, if you're buying $5,000 worth of bricks, then the fees are going to be $25. So overall, you'll be paying $5K plus 25. And if you're selling $5,000 worth of bricks, your actual settlement, the money that you'll be getting into your bank account, will be $4,975, because you're minusing that $25 in fees. That is the fees that BrickX will take. Now, just keep in mind that there are other fees applicable with BrickX as well. These are not the only fees, so make sure you read everything that they have to offer in their fees section, and read the PDFs on all the disclosures and all that sort of stuff. Now, before joining their platform, they even show you a list of the properties that they're managing at the moment, and you can see that they're mostly based in New South Wales and Victoria. I should say Sydney and Melbourne mostly. You've got a whole range of stuff. So you've got actual multi-unit apartments. You've got 6 units in this building. You've also got commercial space as well. So you've got office space, which is about 600 square meters. You've also got more office space in Melbourne. Then scrolling down, you've got basically family houses, pretty standard. So mostly it is residential with a touch of commercial stuff here and there as well. You've got some pretty good locations at Surrey Hill, Potts Point, Manly, and all that sort of stuff, Darlinghurst, Bondi. And with each property, they show you a rough rental yield as well of how much you'll be getting after all the costs per brick. So with most of them, it is less than 3%, we can say. But if we scroll up, some yields are actually a bit higher than that. We can see these yields are almost 6% for residential properties, which is pretty insane. You can also see the historical growth for that actual suburb. You can also see the investors that are invested in each of the properties. So overall, we can see some properties have over like 1,000 investors. I think if you scroll down, one of them has almost 2,000 investors. As we can see, 1.9K people have actually, bought into this property, which is pretty crazy. And yeah, now since this solution is quite innovative, you have to obviously look at the reviews and see what people are saying. So they've got an overall rating of 4.1, but if we look at the negative reviews, mostly people are saying that the fees are quite high. As I said before, the entry and exit fees are 0.5% each, so you are paying 1% to even profit on that. It is quite a lot, and people are saying that you should avoid it. The experience isn't that good, and people are not very professional, and they don't answer you, which kind of sucks. Trash investment. Apparently there is less liquidity because you have to wait for other people to buy your bricks from you. So not looking good on that front. Now, personally, I haven't used BrickX and I don't really see myself using it in the future. But what I will say for platforms like these is the fact that whenever you have someone else managing your investment, you do have to give up some sort of control and some returns as well. So that's basically it. It does give you exposure to property if that's what you're looking for, but do keep in mind that you have to be invested for quite a long time to actually profit from that. If you're happy to collect the dividends, that's fine, But if you're looking for that capital gain, because of that transaction cost, you do have to remain invested for quite some time. So probably more than 5 to 10 years would be my guess. Next up is number 3, which is investing in a managed mortgage fund. So basically how this works is that your money gets pooled together with other investors like yourself, and then the company running the mortgage fund lends that money to companies, developers, and individuals who are basically looking to build residential houses, units, commercial properties, industrial property developments, etc., etc. Now, because you're investing in this fund, you'll be getting monthly distributions, less any fees, and these returns can be as high as 7 to 9% per year, and it'll be paid monthly, which on the outside looks fairly lucrative because these are fairly high returns. But as always, keep in mind the risks that come with it. Generally speaking, the minimum investment required for these types of investments can range from 10K to 25K, although some can be less than this, but this is the starting amount of money you have to invest in the fund, and only then they will consider your application. Once you're invested, you can't take your money out until a couple of months have passed as per their rules, so if you need the money very quickly, you won't be able to access it. Now, just the way that I'm describing this, it may sound like a bit of a pyramid scheme or some sort of a scam. The fact that you have to have a high minimum and then the money gets locked away for quite some time and the returns seem fairly good, almost too good to be true. But the fact is that these types of schemes are quite regulated, but just keep in mind that just because it's regulated, that does not mean that it's risk-free. There's definitely risks there, but it is regulated as well. So just have that assurance that it's not a scam. Now, the other risk is default risk, which means that the developers and the companies that are borrowing this money at very high interest rates, these companies can always go under, right? They may be looking to, build some townhouses or some apartment complexes, and because of rough times, they can't make it anymore. So therefore, they default on the debt. And of course, you, the investor, will suffer because of that. Now, since these funds are pooled together with other investors, the risk to you is going to be fairly minimal. So you may lose a portion of your investment. It is very unlikely that you'll lose all of your investment, but the chance of loss is still definitely there. Now, what will happen is these companies that are running these mortgage schemes will try to take over the property, take over the development, and try to sell it and recoup the cost. But if there's a downturn in the market, the proceeds that they may get may not be the whole debt, so the investor may stand to lose. Now, the reason why these returns are so much higher than other returns that are out there is the fact that this is commercial property, this is commercial financing, this is development financing, and these are business loans. So these developers are charged commercial rates, they're not charged residential rates. So you might go and look for a mortgage and the rate in the market may be around 3%, but sometimes these companies are paying well into the 7s, the 8s, and the 9% to actually finance this because there is quite a lot of risk involved, and oftentimes into the double digits as well. So as we know, with risk and return, if the risk is high, then the return should be high as well, and that is how that whole relationship works. I hope that makes sense. Now look, because this can be fairly risky, I'm not going to name any specific mortgage funds, but all you need to do is just go onto Google and just type up Mortgage Fund Investment Australia, and you'll find lots of websites talking about their offerings and the returns and all the minimums and how long you need to invest for as a minimum as well. So make sure you read everything. These are regulated, otherwise they would be under a lot of trouble. But of course, just because they're regulated, it does not mean that there is no risk. There is certainly risk, so make sure you read everything, speak to a financial advisor, all of that stuff. Now, personally, I don't currently invest in these right now, but I may do it in the future. I may have it as a small portion of my portfolio to give me some sort of consistent income return in times where growth slows down, as we've seen right now with all of the stuff that's happening with interest rates going up. A lot of the growth stocks in tech have taken a massive hit. So having a small portion of your portfolio that is income focused may be an option you can look at. But obviously do not get carried away by the high returns. Anyone that is offering you double-digit returns in this space may be too good to be true, because that is extremely risky. So I would not go through with that. A rule of thumb is always make sure it is less than 2 digits. The last and maybe the least for some people is number 4, which is good old traditional way of buying a property, which is buying a physical property. Now, I know this is extremely hard for a lot of people, but there are lots of things you can do to get yourself closer to that goal. Things like understanding what banks look for in an application, understanding how LMI works, how grants work, how to buy a property with no deposit, how to increase your borrowing power, all that good stuff. If you're interested, check out this playlist right here. I've worked as a broker before, so I've basically compiled all my knowledge into this playlist right here. So go check it out. And guys, thank you for watching. Please like and subscribe, and I'll see you in the next one. Bye now. And you can basically buy REITs from any...